There are 8 billion people on this planet, and there will only ever be 21 million Bitcoin. Do that math right now. That's one Bitcoin for every 380 people alive today. And the vast majority of those coins are already mined, already held, and in many cases already gone forever. Not lost in the markets, not sitting on an exchange. Gone. Permanently. Irretrievably. And that gap between how many people want Bitcoin and how many Bitcoin will ever exist is the most important number in finance right now. That's what we're breaking down today completely from the ground up. I'm AI Ryan Matta. The real Ryan is deep in the research, the thinking, and the writing behind every word in this script. I'm the delivery mechanism, and what I'm delivering today is one of those foundational topics that, once you truly understand it, changes the way you think about money permanently. Not just Bitcoin, money. All of it. Why the 21 million cap exists, how the math works, what happens when you dig into how many Bitcoin are actually available versus how many people think are available, why changing that cap is essentially impossible, and what all of it means for anyone holding Bitcoin right now or thinking about getting in. Let's go. Where the 21 million comes from? When Satoshi Nakamoto launched Bitcoin in January 2009, the code contained a hard ceiling baked directly into the protocol, 21 million coins. Not a corporate policy, not a government regulation, not a handshake agreement between developers. A mathematical limit enforced automatically by every single computer running Bitcoin software on Earth. Right now, as you're watching this, there are tens of thousands of Bitcoin nodes running globally in homes, offices, data centers, on single board computers the size of a credit card, and every single one of them is independently verifying that no transaction violates the 21 million cap. If someone released a modified version of Bitcoin that tried to create coin number 21,001, every legitimate node would reject it instantly. That transaction would be invalid. It would not exist. The network doesn't care who you are or how powerful you are. The math says no. So where did 21 million come from specifically? Here's something most people don't know. Satoshi himself called it an educated guess. In an early email exchange with Marty Malmi, one of Bitcoin's earliest developers, Satoshi explained that the number needed to be set in advance without knowing exactly how the future of Bitcoin would unfold. The goal was to choose a number that would eventually allow Bitcoin prices to be comparable to existing fiat currencies, prices people could understand and relate to, while still preserving extremely high divisibility so the asset could function at any scale. It wasn't handed down from some algorithmic mountain. It was a deliberate, thoughtful choice that combined economic logic with mathematical elegance. And as it turned out, it was exactly right. How the math actually creates 21 million. Now let's talk about the mechanism, because this is where it gets genuinely beautiful. Bitcoin releases new coins through a process called mining. Miners are computers competing to solve a cryptographic puzzle, and every roughly 10 minutes, one of them wins. The winner adds a new block of transactions to the blockchain and receives a reward of freshly minted Bitcoin. When Bitcoin launched in 2009, that reward was 50 BTC per block every 10 minutes. 50 Bitcoin created from nothing awarded to the miner who won. But here's the key. Every 210,000 blocks, which works out to approximately 4 years given the 10-minute block time, that reward gets cut in half. This is the halving. It's not a board vote. It's not a policy decision. It happens automatically at the protocol level the moment block 210,000 is reached, then 420,000, then 630,000, and so on forever. The history looks like this: 50 BTC from 2009 to 2012, then 25, then 12.5, then 625. And in April 2024, we saw the most recent halving bring the block reward down to 3.125 BTC. The next halving, expected around 2028, will take it to 1.5625 BTC, then 0.78125, then half of that, and so on, approaching zero asymptotically, never quite reaching it, but getting infinitely close. When you sum all of those rewards across all halvings, every block ever mined from now until the year 2140, the total converges mathematically to 21 million. This is a geometric series. In high school math, you learn that a geometric series with a ratio less than 1 converges to a finite sum. Bitcoin's block reward schedule is exactly that series. The 21 million cap is not a rule someone enforces. It is the mathematical output of the reward schedule. You can't argue with it any more than you can argue with the fact that the sum of 1/2 plus 1/4 plus 1/8 plus 1/16 going on forever equals exactly 1. The math produces 21 million. Full stop. The last Bitcoin will be mined somewhere around the year 2140. By then, the block reward will have been halved so many times it reaches a fraction of a Satoshi, Bitcoin's smallest unit, 100 millionth of a coin, and effectively becomes zero. After that point, no new Bitcoin will ever be created. Miners will continue operating, securing the network and validating transactions, but they'll be compensated entirely by the transaction fees users pay, not by new coin issuance. The supply is frozen permanently. Where we are right now, and why the window is narrower than most people realize. As of early 2026, approximately 19.9 million Bitcoin have already been mined. That's right around 94 to 95% of the entire supply that will ever exist. Only about 1.1 million Bitcoin remain to be issued, and those 1.1 million will be stretched out over the next 114 years through ever slower halving cycles. So when people talk about getting into Bitcoin early, understand what that actually means in terms of supply. The issuance is essentially done. We are in the final chapters of the only monetary creation event this asset will ever have. Every 4 years, that block reward halves again. The rate at which new supply enters the market gets cut in half. We are already past the point where any meaningful volume of new Bitcoin is hitting the market daily relative to demand. But here's the layer most people completely miss, and this is where the story gets really stark. The real number, how much Bitcoin is actually out there. Of those 19.9 million mined Bitcoin, how many are actually available? How many can actually be bought, sold, transferred? This is where every conversation about Bitcoin supply needs to go deeper, and most people never get here. Blockchain analytics firm Chainalysis has estimated that approximately 3.7 million Bitcoin are permanently lost, gone, inaccessible forever. These are coins that exist on the blockchain. You can see them in wallets, their balances show up, but they can never be moved because the private keys needed to authorize transactions from those wallets are gone. Lost, destroyed, forgotten. And because Bitcoin has no central authority, no help desk, no customer support line that can reset your password, those coins are as unreachable as if they were at the bottom of the ocean. How does this happen? Several ways. In Bitcoin's early days, 2009, 2010, 2011, people were mining coins on laptop computers, treating them the way you might treat random files on a thumb drive. Most early adopters had no idea what these coins would eventually be worth. They casually stored wallet files without backup. They reformatted hard drives. They threw out old computers. One of the most famous cases, a British IT engineer named James Howells mined 8,000 Bitcoin in 2009 and accidentally threw away the hard drive containing his wallet when he was cleaning his home in 2013. That hard drive is now sitting somewhere in a landfill in Newport, Wales. He knows approximately where. He has spent years trying to get permission to excavate it. Local authorities have repeatedly refused. Those 8,000 Bitcoin are effectively gone. At today's prices, we're talking hundreds of millions of dollars buried in literal trash. Then there's Stefan Thomas, a programmer who owns a wallet containing over 7,000 Bitcoin, but has forgotten the password to the encrypted iron key drive that holds his private keys. He has a limited number of guesses before the drive permanently encrypts itself. He has tried. He has failed. Millions and millions of dollars in Bitcoin sitting in a wallet he can see but cannot touch. And then there's Satoshi. The person, or persons, who created Bitcoin mined approximately 1 million BTC during the early days of the network. Those coins are spread across roughly 20,000 addresses. None of them have ever moved. Not once since 2010. Whether Satoshi is no longer alive, whether the keys were deliberately destroyed, whether this is a long-term hold that will never be liquidated, nobody knows. The Bitcoin community has largely reached a consensus. Treat Satoshi's coins as gone. They're excluded from most circulating supply models. If even one of those wallets ever moved a single Bitcoin, it would be the most significant market event in crypto history. Everything would go haywire. The signal would be so loud it would break the internet, and it hasn't happened in over 15 years. Added up, Chainalysis's floor estimate of lost coins is around 3.7 million. Some researchers put it higher, up to 4 million or beyond when you include Satoshi's stash. Beyond lost coins, you have long-term holders, people and institutions who have publicly committed to never selling, who treat their Bitcoin as a multi-decade or even multi-generational asset, moving it into cold storage and walking away. Publicly available blockchain data consistently shows that something like 70 to 75% of the circulating supply hasn't moved in over a year. Some analysts who look at truly liquid Bitcoin, coins that are actively on exchanges or could realistically enter the market in the near term, put that number somewhere around 3 to 4 million coins, maybe less. 3 to 4 million liquid Bitcoin, 8 billion people, and global institutional demand that is now measured in billions of dollars per week. Satoshi wrote something about this that I keep coming back to. In an early forum post, Satoshi said, and I'll paraphrase because what matters is the logic, not the exact words, that lost coins make everyone else's coins more valuable, like a donation to everyone. Every time a coin is permanently lost, every remaining coin in every other wallet gets fractionally more scarce. The person who lost their hard drive, inadvertently or not, made your Bitcoin worth a little more. The math is relentless. Every lost coin tightens the supply. And supply only goes in one direction. Why the cap cannot be changed, and why that matters more than anything. This is the question that comes up every time someone new to Bitcoin starts thinking seriously about it. What stops developers from just changing the code? It's open source software. Anyone can read it. Anyone can fork it. So what prevents someone from proposing a change that raises the cap to, say, 42 million? The answer requires understanding how Bitcoin's governance actually works, because it is unlike any system most people have ever encountered. Bitcoin has no CEO. It has no headquarters. It has no board of directors. There is no entity that controls it. Changes to the Bitcoin protocol require consensus, not a majority vote, but genuine overwhelming consensus from every major constituency in the network simultaneously. Developers, node operators, miners, exchanges, and large-scale holders all have to align. And here's the crucial part. Node operators are the ultimate enforcers. If a developer releases a version of Bitcoin that changes the cap, node operators simply don't run it. They keep running the old version. And since the nodes define what the valid chain is, the developer's new version becomes irrelevant. It's a separate network. Nobody accepts it. It has no value. The 2017 block size wars are the clearest historical proof of this. A significant faction of the Bitcoin ecosystem, including some major miners and businesses, wanted to change a core parameter of Bitcoin's protocol. They had resources. They had influence. They campaigned aggressively. They lost. The Bitcoin network rejected the change and kept its original rules. The faction that tried to force the change ended up on a separate chain, Bitcoin Cash, which has a tiny fraction of Bitcoin's market cap and relevance today. That's what happens when you try to change Bitcoin's rules without genuine consensus. You end up on a minority chain that the market doesn't care about. Now add the economic incentives. Bitcoin's value, the reason a single coin is worth what it is largely derived from scarcity. Every major institution that has allocated to Bitcoin, BlackRock, MicroStrategy, sovereign wealth funds, public pension funds, nation states, made that allocation specifically because the supply cap is fixed and mathematically guaranteed. The moment you threaten that guarantee, you destroy the thesis. You don't just put a dent in the price, you undermine the entire reason sophisticated capital entered this asset in the first place. And miners, whose revenue depends on Bitcoin's fiat-denominated price, would watch their business evaporate. Miners pay electricity bills in dollars. They service equipment debt in dollars. Inflating Bitcoin supply might increase their revenue in Bitcoin terms for a moment, but the resulting price collapse would destroy their fiat revenue permanently. No miner on Earth has an incentive to support a supply cap change. They're economically trapped into defending it. This is genuinely unprecedented in monetary history. Think about that for a moment. Every single currency that has ever existed, every coin struck by every empire, every note printed by every central bank, every digital currency issued by every government has had its supply controlled by human beings. Kings clipped the edges of coins to extract gold. Roman emperors debased the denarius by reducing its silver content. The Weimar Republic printed marks into worthlessness. The Fed expanded its balance sheet by trillions in 2020. Every form of money ever created has had a human hand on the supply dial. And that human hand has always eventually turned it the wrong way. Because there's always a short-term reason to issue more, bail out a bank, finance a war, stimulate an economy. The incentive to inflate is always present. The discipline to resist it has, across the entire span of human civilization, always eventually failed. Bitcoin is the first monetary asset in human history where the supply schedule is set by mathematics and enforced by a decentralized network that no single human being, government, or institution controls. Nobody can call a meeting and vote to change it. Nobody can issue an executive order. Nobody can hack the supply. The 21 million is not a promise. Promises get broken. It is a mathematical property of the system, enforced by thousands of independent nodes simultaneously, backed by the most powerful computing network ever assembled. That's a categorically different kind of money. The big picture, what this means for you, let's bring this home. Gold has been humanity's preferred store of value for thousands of years, and its staying power comes from one primary property. It's hard to produce more of it. Mining gold is expensive, dangerous, and physically limited by geology. Gold's annual supply grows at roughly 1.5 to 2% per year. Consistent, but present. The supply does grow. Bitcoin's current annual issuance rate is already below 1%. After the next halving in 2028, it drops again. After 2032, it drops again. By the 2040s, Bitcoin's annual supply growth will be a rounding error. By 2140, it's zero. Bitcoin isn't just harder money than gold. It's categorically harder money than anything that has ever existed because its supply growth rate converges to a mathematical absolute zero. And then there's divisibility. One of the objections people raise is that 21 million coins sounds like a small number for a global monetary asset. How can something priced at $100,000 or more per coin ever serve as everyday money? This is where the Satoshi matters. One Bitcoin equals 100 million Satoshis. Even at $1 million per Bitcoin, and there are credible, serious analysts making that case for this decade, one Satoshi would equal 1 cent. The asset scales perfectly. The 21 million cap doesn't create a scarcity problem for transactions. It creates scarcity of the asset as a whole while preserving full functionality at any price level. If you're holding Bitcoin right now, you are holding the most supply-constrained monetary asset ever created. Every halving tightens new supply. Every lost coin makes existing coins incrementally more scarce. Every new buyer, every institution, every sovereign wealth fund, every government that adds Bitcoin to a reserve is competing for a pool that can only ever get smaller. The 21 million is not a talking point. It's not marketing. It's mathematics. And unlike every other form of money you've ever held in your hands or in your bank account, nobody can change it. If you want to see how that math translates into your actual retirement numbers and how much Bitcoin you'd need at what price targets to hit specific goals, Ryan built a free Bitcoin retirement calculator at bitcoinmaxing.com. There's no paywall. You just put in your numbers and see where you stand. That's bitcoinmaxing.com. And if this gave you something real to think about, hit subscribe. We publish consistently, we go deep, and the next video is already coming.